Hey guys, welcome back. Since there were a lot of requests for this, today I will walk you through 5 simple steps of doing a stock analysis. We will do a simplified version walking you through each step to explain our thoughts on the stock we're interested in, if it is a buy or not, and how to determine the buying price. There are a lot of YouTubers out there that will give you a generic ratio and their stock picks, but they don't provide you with deep analysis or an explanation of the process. Here, we want you to understand the process in hopes that when you do your own research, you will have a good, strong understanding of what you're buying. By the way, if you find this video helpful, please smash the like button and subscribe. It really helps to support this channel and ensures that you get all the latest updates. Okay, so step number 1. You must first ask yourself, is this stock within your circle of competency? I.e., do you know the products or services that this company offers and how the business works? Easy, right? Though it sounds simple, not many people keep strictly to this mantra, especially when they're always jumping onto the next hype stock that everyone's talking about. But what I found that on the long term, you will be better off sticking to what you know. Thus, the important golden rule here is to only invest in what you know. Buying shares is the same as giving someone money to own a piece of their business. Therefore, we want to make sure we understand as much as we can about the company and its operation. Now, for our example today, we will look at Facebook. Yes, it is in my core competency because I grew up using Facebook. I use Facebook all the time. This is how I connect to my friends and family, get updated news, buy, sell various things, and even do business. I'm on it all the time every day. I love the product. Of course, you might think differently, and that's okay. Maybe this stock is not for you. There are many other stocks you may know or like better. The important thing is you learn the process. Step 2. Do you understand the business operation and its performance? Does it have a strong business model? Does it have a competitive advantage? Is it profitable, growing? Will it continue to grow in the future? Who are its competitors and how does it compare to them? So first, yes, Facebook has a very strong business model. It has the main Facebook platform app, Messenger, Instagram, WhatsApp, and various other businesses like Oculus. Combined, its family of apps as of the latest Q3 report has about 2.54 billion people using it daily, which is up 15% year over year. Of course, there may be some commingling of data here, as some people may use more than one app like myself. But still, this is a staggering amount of users on a daily basis. Facebook also has a very strong competitive advantage, although it competes for your attention against YouTube, Netflix, Apple apps, games, etc. Overall, in my opinion, Facebook is very sticky. As I've said, I'm on it all the time. I use Facebook for newsfeed, Messenger for chatting with friends and family, WhatsApp to chat with business associates. Although I don't use Instagram a lot, I know a lot of people who do. They're so dominant in what they do. Okay, so now that we know the business model is strong, we must look at the fundamentals to get a good idea of how strong the business operation is. In Q3, Facebook had sales of 21.4 billion, growing at 21.6%. It has been growing every year. It had net income of 7.8 billion and a net profit margin of 36%. That means for every dollar in sales, it earns 36 cents after deducting all its costs. It also has a great balance sheet with over 55 billion in cash and only 11 billion in debt. It had free cash flow of 6.5 billion, which we get by taking the 9.8 billion in cash flow it makes from operations minus the 3.6 billion it used for expenditures. Expenditures, for example, are money used to buy assets or investment which the company thinks will help it grow or expand, such as office buildings or even companies like Oculus. Therefore, even after these large expenses, it still had 6.5 billion last quarter to add to its growing bank balance. Overall, Facebook's business has been doing great, and that's why the share price has appreciated dramatically since IPO in 2012 at $38. Next, let's look at Facebook's valuation and also later compare Facebook with its competitors. Although technically Facebook has many competitors that it has to compete with for your attention. Its main business is selling advertisement on its platform. In this case, we will compare Facebook with Google, as Google is the largest ad seller controlling over 30% of all ad revenue as compared to Facebook's 22% market share. When we look at valuation, we have to really put them into categories such as growth or value. as each type will have different metrics. Growth stocks are generally companies that usually make no money and have crazy revenue growth, such as Zoom, Tesla, Peloton, etc., etc. While value companies are safer cash flow business that makes consistent profit but do not grow very much. For example, companies like Verizon, Walmart, etc. Facebook used to be a high growth stock in its early IPO years, but now I think of more as a mixture of both. Facebook generates tons of profit and still has been able to grow 20-30% each year. Thus, for value companies, a popular metric to use is EV to EBITDA ratio, since we want to look at how expensive it is relative to its cash flow. EV stands for enterprise value. Basically, this is the current market value plus liabilities minus cash. It reflects the full real price someone would have to pay for the company. Here, Facebook's EV is $744 billion. Next, EBITDA stands for earnings before interest, tax, depreciation, amortization. The reason we don't care about interest, tax, depreciation, amortization is that we just want to look at the actual operation earning of the company, as this really shows how much cash the company makes from just running its business. The other items, although important, are deduction items or items that are non-core factors. Hence, industry experts typically use EBITDA for non-high growth companies. Here, Facebook's estimated 2021 EBITDA is $51.43 billion. Its EV to EBITDA ratio is 14.5 billion. So when we look at EV to EBITDA, basically we're saying how many times cash is the company being valued at? Or put it another way, if I buy 1 shares today, then it will take me that many years to get my original investment back. Here we see that Facebook trades at 14.5x forward EBITDA, and its largest competitor, Google, trades at also 14.5x. The golden rule is that if the multiple is less than the growth rate, then it is good, because that means it is growing faster than what is expected, and thus you should expect to see higher stock appreciation and earnings beats. Thus, both companies are trading at relatively good valuation based on future estimates. However, if you look at the growth rate of Facebook, it is expected to grow 24%, whereas Google is expected to grow only about 20%. Hence, although both are good buys, Facebook seems to be the better value. Step 3. What is the current economic condition, and is it favorable for your company? The current condition, as you know, is quite bad. COVID has derailed the economy, many businesses have gone bankrupt, COVID cases are rising every day, millions are unemployed, millions have expired or expiring unemployment benefits, there's no stimulus plan in sight, and globally the world's in a recession. Although there are some good news, such as the positive vaccine trials, however, it may still take some time until it's available for everyone. There could be a new stimulus next year as well with the new Biden administration, so the economy could improve. Facebook overall has done quite well. Although total ad spending was down due to business cutting costs, advertisers shifted a lot of traditional media spending to online ads. This made sense because everyone was at home and spending more time online. Hence, companies like Facebook did very well. Furthermore, it is expected by 2026, total online ad spend will more than double to $626 billion. Therefore, Facebook should continue to grow its user base, earn more revenue, and become even stronger post-pandemic. Step 4. Is there a catalyst or future event that will drive the stock price higher? Yes. Facebook has been making more updates and changes to its app. For example, Instagram recently introduced Reels, which is similar to TikTok, allowing users to create and share short videos with music, etc. If TikTok gets banned, or if it just captures a small amount of those users, Instagram should be able to gain more users. Instagram also has been focusing more on its in-app purchase and shopping. This should help to attract more advertisers and brands as well. Next, Facebook has been pushing hard on online shopping to its platform and for more small businesses to go online. Recently, it just announced it will purchase Customer, which is a CRM chatbot company. This should help small businesses on its platform by providing more tools to close a sale or better engage with a customer. Then there's also a new digital payment business through WhatsApp similar to Venmo or Cash App, which is now available in high potential markets such as India, Indonesia, and Mexico. This could potentially be a very large and profitable revenue stream. Lastly, we also have Oculus. They recently partnered with the NBA to do virtual courtside seats during the bubble. Once the technology improves and VR adoption increases, Facebook could see more revenue from Oculus. Hence, there are many catalysts for the stock price to go higher. Though we must also consider the risks. Governments globally, including the US recently, have been pushing for more regulation on big tech. Hence, Facebook could face high political risks and large tax penalties, which could impact their business. Although in my opinion, I don't think that the government will break up the company or that more regulation will harm the business. More regulation may be better for everyone long term. Overall, the important thing is that we must understand and consider the risks and then decide if it is acceptable to us or not. Here, I think the risk is acceptable given the potential upside. Step 5. Now that we know it is a good company, financials are good, there are many catalysts to move the price higher, well then what is a good price to buy it at? Some people like to stick with all fundamentals or all technical analysis. I like to use both. Here, since we looked at the fundamentals already and determined that it is a good stock to buy, we still want to get at the cheapest price. Thus, let's look at the technicals to see if there is a good indication of key levels to set our target buy price. Although I'm by far not an expert in this area, I do very much respect it and have a basic understanding. I've always found it helpful as a guiding point of where to start. Here, you can see the resistance and the support level. Right now, Facebook last traded at around $277 and is trading within the range of $300 and $260 for the past month. You can see at the top, there's a lot of selling pressure or resistance at around $300. Around $260, there's a lot of support. 3 times when it previously dropped to near $260, buyers came in and pushed the price back up. Hence, $260-ish is a good price to wait for a pullback to buy. And now for my final tip and reminder. Always remember to only invest in what you know. I hope this video was helpful. Thanks again for watching. Please don't forget to subscribe.